Hello, my name is Danish, and today I will be discussing one of the most significant corporate scandals in American history, the collapse of Enron and what it taught the world about corporate accountability, auditing, and ethical leadership. Enron was one of the largest and most respected energy companies in the United States. However, behind the scene, executives used fraudulent accounting practices to hide billions in debt and inflate profits. The company relied on mark to market accounting and off balance sheet partnership, which allowed them to prevent false image of financial success. As more lies were stacked on top of each other, Enron eventually collapsed in 2001, wiping out thousands of jobs, retirement accounts, and investors' funds. These scandals exposed major weakness in corporate oversight and directly led to the creation of Sarbanes-Oxley Act, such as known as SOA. To understand the Enron case in depth, I reviewed multiple high-quality sources. This includes documentary videos explaining the fraud article from credible news organizations such as the Houston Chronicle and additional research from the FBI's historical case summary. I also examined analysis from business and accounting experts to understand how internal decisions and external oversight failures contributed to the collapse. The Sarbanes-Oxley Act was passed in 2002 as a direct response to the Enron scandal. Its purpose is to protect investors by increasing transparency in corporate financial reporting, which includes in Section 302, which requires CEOs and CFOs to personally certify the accuracy of financial statements. Section 404 requires internal controls to be documented and audited. Section 802 establishes strict rules for preserving electronic records. SOX could have prevented Enron's fraud because it forces executives to take responsibilities for reports and prevent companies from hiding debts through off balance sheet practices. It also strengthens the role of auditors and increases penalty for falsifying information. Corporate culture and leadership played a major role in enabling Enron's fraud. Executives like Jeff Skink and Kenneth Lay prompted a culture of high risk, aggressive profit goals, and secrecy. Employees were pressured to meet unrealistic performance expectations even if it meant bending the rules. Faculty accounting, sorry, Faulty accounting practices also contributed heavily. Enron used mark to market accounting to record potential future profits as if they were guaranteed income. They also created shell companies called special purpose entities to hide debt and inflate earnings. External agencies such as Arthur Anderson, Enron's accounting firm, were complicit because they approved fraudulent financial statements. Investment banks, credit rating agencies, and some executives listed in public case record also played a role. According to FBI, IT audit helped uncover emails, digital financial records, and deleted documents that revealed how much Enron had manipulated numbers of and destroyed evidence. If a through IT audit had been conducted earlier, it is possible the fraud could have been caught before the collapse because many digital documents clearly showed fraudulent activities. The Aaron scandals teaches that strong corporate accountability, independent auditing, and the government regulations are essential to prevent fraud. It exposed major weakness in how corporations were monitored and forced major reform in the auditing professions. The human impact of the scandal was devastating. More than 20,000 Enron employees lost their jobs and retirement savings. Many had invested their entire pension in Enron stocks, which become worthless overnight. The lesson for professionals today is that ethical decision making must always come before profit. Employees should never rely entirely on a single employer for financial security.